This segment sponsored by Foster Financial. Welcome back to another edition of Money Monday with Foster Financial, and Caleb Doane, their vice president, is here to share some really interesting information about the market. Hey there, Caleb.
Hey,
how are you?
I'm doing well. How are you?
Good. Okay. This market, as we have talked about, goes up and down. It changes every day. But right now, there are particular dips that are happening. So tell us, what is the temperature?
Yeah. So, I mean, over the last couple of years, of course, we've seen some of these dips and spikes in the market. So it's been interesting in that, if we look back at 2025, everyone kind of remembers the first quarter of the year. People were talking about tariffs a lot in Washington. And so the stock market dropped a little bit, recovered, and then so far yet this year, there have been similar dips and spikes in the market too, with what's going on in Iran and the conflict in the Middle East. We've seen some dips, and then we've also seen some recoveries since then. And I think it starts to beg the question of, hey, is this volatility just normal in the market, or is this a really
norm?
Yeah, exactly. And when we look back historically, honestly, it ends up being relatively common to see some of these dips. So if we look at 2025, the S&P 500 over the course of the year finished up right around 16% for the calendar year of 2025. And yet there was a point during the year where it was down 19% from a recent high that it had. And so that's not terribly uncommon to see when we look back over the last 50 years of the S&P 500. We do see some of these spikes and dips. And so it's important, if you're younger, oftentimes you're a little bit more growth oriented or a little bit more aggressive. And so you're probably going to feel more of those spikes and more of those dips. A lot of times it's really important to stay invested during those times. Everyone's financial plan is unique, of course, but as you get closer to retirement, usually people want to see less volatility in their accounts. And so that's where a lot of times historically advisors have added in bonds to the portfolio, but there are a lot of other unique ways to still get good upside participation, but limit the volatility outside of just bonds.
Wow. Well, especially with the volatility having a lot to do with the word war and when that's placed and when it's shared and when it sounds resolved and not resolved. And so I feel really bad for anyone who's going through those retirement stages right now because they are experiencing that. And so how should investors react to the spikes and the dips? What should they do?
Yeah, I mean, the best case is to have a plan ahead of time, of course, right? So when we're dealing with folks who are in retirement and they're taking withdrawals, we're keeping 3 to 5 years worth of withdrawals, expected withdrawals, in conservative assets. So oftentimes this is kind of the bond sleeve of the portfolio. And then at the same time, there's a lot that can be done on top of that to reduce volatility in the accounts. There are certain low volatility positions that can be used. Oftentimes we might cycle in buffered funds into the portfolio that might reduce some of the downside exposure. It buffers out some of the downside and then gives you upside participation still. We also add in investments that have a nice track record of good, solid returns, but aren't as correlated to the S&P 500. So a lot of times it feels like the S&P 500 just kind of dictates what the entire market does. We want to make sure we're invested in things that are still, producing good returns, but are maybe less correlated to reduce some of that volatility.
Interesting. So now with this new normal, it really should be expected. So through the strategies that you build out for your clients, you are putting in these contingencies. If the market shifts, that they're still okay. Now, what if you see a market that dips so quick and so crazy, it's like, oh my goodness, do you just let it ride out, or do you advise maybe switching over some of the assets?
It's a good question. I mean, we kind of saw something like that in COVID, right? I mean, there was a big dip around COVID. Nobody really knew what was going on. And that's when it can be really important to keep a cool head in those times. There are certain tax strategies that we'll use when the market drops like that. We were certainly anticipating a relatively quick recovery when the market had dropped. And so I think having a plan ahead of time and saying, hey, we've got enough money set aside for 3 to 5 years worth of withdrawals here. We're expecting a recovery prior to that. That gives clients a lot of confidence in those scenarios to be able to stay invested even during those dips. Sometimes we have clients too where we'll give them a call when the market drops. We know that they're maybe a little bit more on the growth-oriented or aggressive side of the risk spectrum. And we'll say, hey, now could actually be a good buying opportunity when the market drops. And so it's a little bit about going against your instinct. When you see the market drop, it can be difficult to buy in more or keep contributing to the 401k. But in some circumstances, that's the best case or best outcome to continue to do there.
Wow, interesting. Okay, well, keep your eyes on the market for us, as I know that you will.
Certainly.
And thank you for that info.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their website and phone number listed below. Give them a call to start strategizing. And I'll see you after the break. This segment sponsored by Foster Financial.